It's the rainy season, time to take out your gum boots or rubber shoes, and if you didn't have one, chances are you've already gone out and got one. One company that stands to gain from this shopping spree is Khadim India. What's also working in their favor is lower rubber prices and the overall move towards branded retail across price segments. So is the shoemaker making the most of the shopping spree? Let's find that out from the CFO of Khadim India, Ms. Ishani Ray. She joins us right now on the show. Ms. Ray, good morning and thank you so much for taking the time out and joining in. Before we get to the big picture, just wondering, does this turn out to be an annual seasonal trend as well? That demand within products of this nature which are more used in the rainy season tends to favor the company, and this coupled with lower rubber prices as we've seen in the overall markets might also be adding a twin benefit to you as a company.
Well, yes, monsoon is an important season for the company or any other company in the distribution segment, and we especially, since we pioneer in manufacturing PVC-based products, we are affected by a good monsoon, yes. But when you are talking about impact of rubber prices coming down on the business as a whole and the profitability or the margin, we need to understand that rubber forms one of the constituents of our manufacturing base. But primarily the products are crude based. So though there was a fall in the rubber price, but there was not major impact because on the other hand, the crude prices were on the higher side.
Okay, so I'm guessing from your answer that you are saying that there's not a dramatic impact that people can expect on the operational metrics of the company in the near term because of the fall in rubber prices.
Yes, rubber prices does not have any impact.
Interesting. Okay, let's talk about business by and large. I was reading a couple of reports that have come out from analysts who have recently met your company, and all of them seem to be bullish. That the interesting bit that, for example, an Axis Capital note speaks about you for the next 2 or 3 years is that the growth in profits will be better than the growth in EBITDA, which will be better than the growth in revenues, arguably due to operating leverage and better return ratios. Is this the kind of growth that you envisage Khadim India to clock in over the course of the next 3 years?
We expect definitely a higher growth in the PAT than the EBITDA and than the revenue, because in both the segments, be it retail or be it distribution, we plan to scale up our business on an asset-light model. So there would be better impact on the profitability of the company and the return ratios. On top of that, we are constantly working on value engineering of the products, and we expect to benefit from the scale of operations also. So with the economies of scale setting in, gross margin improving through constant value engineering, we expect to have a better impact on the EBITDA and the profit. And in any case, sales would be growing at the rate that you have already given a guidance on, around 18 to 20% on an overall basis.
Interesting. So viewers, for the benefit of all of you who are listening into it right now, the one note that I was talking about, which is from Axis Capital, speaks about how this company will benefit as a result of operating leverage coming into play and the fact that it's a structural play on the fast-growing value for money footwear market. This is what Axis Capital says in its note. Affordable footwear brand catering to the needs of all members for all occasions. I think they're spread across the value chain in tier 3 cities particularly, but now starting to probably wanting to make a mark in the non-tier 3 city network as well. The retail business constitutes about 66% and the distribution business about 24%. They have some other businesses, which is institutional business and servicing certain government departments in 3 states, which constitutes about 10% of the FY18 sales. With the plans that you have in mind, Ms. Ray, where do you expect the contribution from each of these categories to be like? Would each of these grow in a similar way, and therefore would retail constitute about 2/3 or 66% of your business, and distribution, will it continue to account for about 24-25% of your business going ahead as well?
See, we expect retail business to grow at at a pace of around 13-14%, whereas distribution would be growing at somewhere around anywhere between 26 to 28%. So definitely going forward, the share of retail and the distribution business would not remain in that 66 and 22 or 23 odd ratios that we see today, because the distribution business is growing at a higher CAGR. So it would be anywhere around maybe 60-40, and the other business that we are talking about, institutional sales, at no point of time it would be more than 10% of the overall revenue.
Would your sales be buoyed largely by what's happening to the organized retail space as well? I mean, the reason I ask this is twofold. One, that companies that we speak to, the likes of V-Mart, etc., speak about how a 20-25% CAGR for the next 3, 4, 5 years seems to be a certainty. Would you benefit in part because of the growth in organized retail, or would you, through your own stores or your network stores, anyways gain irrespective of what's happening to large organized retail?
The impact of the organized retail growing at a faster pace does have a bearing on the company's growth also, because there's the natural buoyancy in the market. But we expect our retail chain to grow at anywhere between 13-14%. And if we look at footwear retail as a segment, that is growing at a rate of 14 or 15%. So we would be in sync with the industry rate. Distribution, on the other hand, is a segment which industry is growing at anywhere between 20-23%. There we expect to outbid the industry and grow somewhere around 26-27%.
Am I to assume, Ms. Ray, that over the course of the next 2 years, in a product like yours, wherein, or at the scale like yours, wherein margin expansion might not be that easy, you would still clock in some bit of EBITDA margin expansion, 100-150 basis points? Is that possible largely over the next couple of years?
We expect to improve our EBITDA margin by 50 basis points on a year-on-year basis, maybe for the next 2-3 years. So yes, we do expect that type of EBITDA margin improvement.
Does all of this due to return ratios as well? And the reason I ask this too is twofold again. I think one of the notes says that they believe that your return on capital could actually move up almost 400-500 basis points over the next 2 years. Is that a distinct possibility?
Yeah, that is a possibility. Reason being that our entire growth model is a satellite model. Since our growth, as we have seen before also, the expansion comes from both company-owned company outlet opening as well as franchisee outlet opening. And of the total new openings, about 75% is your franchisee opening, where the capex involvement is virtually zero. So naturally, there's an improvement in ROAS. And similarly, in distribution business, since we are yet to utilize the full capacity, with better utilization of the capacity in the years to come, there also the ROAS is expected to improve. So on overall basis, there would be improvement in ROAS.
Okay. Last couple of questions. You know, I might be wrong here, but I would presume the shift towards online, at least in the tier 3 and tier 4, would have been slower than the kind of shift that we've seen in tier 1 metros and tier 2 as well. Now, you are large, correct me if I'm wrong, but you have a significant presence in the tier 3 cities. You have quite a bit of presence in East India as well, wherein the markets might largely be untested to the onslaught of online retail. Is that a high and real risk for a business like yours?
I wouldn't say it's a real risk. Till now, we have not seen onslaught of online on footwear segment per se, other than a few specific genres like your sports shoes, etc. But saying so, and particularly in the tier 2 and tier 3, we have really not seen the onslaught of online. But saying so, we as an organization, we have presence in all the online marketplaces. We have the product lineup. So in case there is, we can scale up our presence. And I don't think that would pose to be any threat. We are geared up to take the challenge.
That will not have a bearing on margins. You will grow your operational margins irrespective of the kind of discounts or the kind of cuts that you would have to have on the online space versus your own businesses.
Yeah, because the brick and mortar business and the online business are two different spectrums and ball games. So according to you have to have your product profile and your margin set up to cater to the online segment. We have already done our homework, so I don't think it would be a problem.
Okay. And therefore, my last question, Ms. Ray, if you indeed grow about 15 to 20% on the top line, coupled with the kind of expectations on the operational front, uptick in return ratios, etc., would it be safe to assume that your bottom line performance could be northwards of 30% CAGR for the next 2 years at least, if not more?
Yes, I think so.
That's a safe assumption. Would be northwards of 30%, would be what, 30, 35%, or would you believe it could be higher than that as well?
I would restrict myself to anywhere between 30-32%.
Okay, that's an impressive number as well, and we wish you all the best for that. Lovely talking to you today, Ms. Ray. Thank you so much for taking the time out, and all the best for the quarters ahead.